People do disagree. I have one of them with us now. Not everyone is bullish about the stock market, nor the U.S. economy or the global economy. Concerns over the value of the U.S. dollar also weighing on this gentleman's mind. Also, the possibility of a disruption in Middle East oil supplies. These are all the top of his bear list. My next guest says this could shatter the bull market and ruin its advance. Charles Ortel, Managing Director, Newport Value Partners. Charles, when I knew you were coming on, I thought, uh-oh, I got to get a rock. I got to go hide somewhere. Because you've got no good news. I mean, come on. Let me give you the good news. Notwithstanding Laszlo Barigny and Barton Biggs, two very smart people, you got to ask yourself the question: did you catch this increase, this rise in stock prices over the last 2 years?
No, I didn't. But I think very few people actually were smart enough to call the market and say take their bait off the table in December 31st, 1999, or more recently August of 2008. And yes, there are some very smart people who did that and put money in at the absolute low on March 9th. But our fundamental thesis is that if you go back and examine the macro world, we think the proper reference period is 1945 to 1999, a very unusual period in world economic history where America clearly was on the ascendancy and there were a lot of major gale force tailwinds propelling the economy and equities and securities upwards. After 1999, our fundamental contention is that equity investors have not been properly compensated for the risk they've been taking.
You think they should have made more money?
Absolutely. I mean, and if you look, for example, at, I don't know, it's a marginally flawed statistic, the VIX index, but you go back and you
volatility. That's the measure of volatility.
What investors expected volatility to be, and then you look at what the returns were like in those same periods. You see that investors were fundamentally not compensated properly in dollar terms. Then if you take a step back and you say, look, the dollar is an interesting currency. It was, the rock of ages for a long period of time. But between 1999 and the present, it frankly has not been, especially when you norm it to gold or some other stores of value outside gold if you don't like precious metals. Investors really in most securities have been smoked since 1999. Since March 9th, 2009, yes, equity investors, even corrected for gold, have done all right. But again, we don't think they've been compensated fairly for the risks they've taken. We're fundamental analysts. When we look at equities, we do not buy the argument that the correct yardstick to use is PEs. We don't think.
You want to look at cash flow, I know. Free cash flow. Absolutely. We're talking about the state of the global economy. Is it due for a reality check? And what happens to stocks if indeed we do get a shock? My guest, Charles Ortel, Managing Partner, Newport Value Partners. All right, Charles, I got the sense you're bearish. You mentioned the U.S. dollar. Compare people's investments using the U.S. dollar. Compare it to gold. We understand. Dollar has fallen. Gold has appreciated in price. Maybe gold an inflation hedge. How concerned are you about inflation?
I'm very concerned about inflation. Inflation is a statistic that governments massage, and it's possible to play a lot of tricks with inflation because it counts not simply your operating costs, but also changes in asset values.
Well, it also is a factor when you consider the amount of money that governments pay out in terms of cost of living adjustments.
Absolutely.
If you don't have an increase in the CPI, the government doesn't write a bigger check.
Absolutely. And so the United States dollar, as we mentioned in the previous segment, has been the beneficiary of an appetite that's been fueled for decades. And our concern is that since really January of 2009, we would argue that the training wheels were put on the global economy. And those training wheels have not translated into robust increases in intrinsic unfinanced demand in personal consumption around the world. You don't see it, especially if you adjust for per household figures. You mentioned Walmart earlier. If you look at Walmart's sales, same-store sales are down, but then adjusted for household growth, they're down even more. So we're not seeing the type of strong resurgence that you would expect for the extraordinary measures that were taken.
So do you think we're going through a period of deleveraging, of deflation? I mean, you can have both, right? You can have some inflation in some areas, but a general pattern of deflation in others.
See, I think, speaking first about the U.S. economy, I think in the U.S. we have a structural trade deficit. And you can see that if you go back over long periods of time. When the dollar was strong, we had a trade deficit. When the dollar was weak, we have a trade deficit. Our exports are already very large as a percentage of of world demand. And it's not as if, when we think about exporting into these up-and-coming large economies, that the large economies want to just welcome American-made goods. They have their old nascent industries that are competing against us. So we feel we have a structural trade deficit in the United States and certainly these other large economies.
How should we fight back about that? What should we do? Should we increase tariffs? Should we get rid of a lot of the free trade agreements that have already been negotiated? Doesn't that hurt the U.S.-built domestic economy?
I think the biggest obstacle to growth in this country is the size, the total size of government. I think that Meredith Whitney had some of what she said exactly right. I think the attention on the federal government deficit is misplaced because it's just a portion of total spending. It's roughly 60% of government spending. If you add in state and local and affiliated spending, it's a gigantic number as a percentage of GDP. And you got to ask yourself in 2011, how much government is enough government? I mean, it's not as if for all this government spending we have the #1 educational system in the world. It's not as if we can control our own border. It's not as if we're winning 2 wars that we've been fighting since September of 2001. And, you know, it seems to me if this were a household, we'd be saying, time to trim. And not just by doing the stuff that Paul Ryan and others are talking about, by redefining the mission of government in this country, by asking ourselves, with all the advances in innovation and technology, do we really need to keep people in high school for 4 years, or should it be 3 years?
Well, indeed, that question was asked in a recent Bloomberg poll, and it turns out that people said, yes, the #1 concern is the U.S. deficit, the idea being that you've got to somehow figure out how to take in and spend more or less the same amount. Yet when asked what should be cut, should it be entitlements? The answer was no. We don't want those things cut. So you've got this contradiction. On the one hand, it's, yes, we want it cut, we want it balanced, but don't cut anything that affects me.
Well, and that's what brings us to a reason for being pessimistic about the next period through, say, September of 2012. We don't see the internal will in this country to forge a solution that makes sense. We see just what you're talking about. Everyone sitting around the table saying, you should cut, and I'm not going to cut, and nothing gets done. And so we're going to go through a period here, like we're seeing in Madison and state capitals across the country, in cities around the country. We're going to see a lot of talk of 2 hardened camps. One camp that wants a collectivist solution, and that's not going to work. It never has worked, and it never will work. Equality of outcome simply never happens without surrendering freedom. And on the other side, the individualist approach, you know, it looks like it didn't work. So there's going to be this intense battle and volatility going forward, and we think outside hands are going to forge a solution in bond vigilantism, in rising external interest rates.
Well, we had the news today that Bill Gross doesn't own any government-backed securities anymore in his fund.
A remarkable statement from a man who manages one of the largest bond funds in the world. I mean,
so what would you counsel investors to do with their money, given that you believe we're going to go through this period of volatility, through a period where we're not going to get much done, as you described? What should they do with their money?
Well, I think if you're talking about a modest investor, not a Bill Gross, the first question Americans and people who live in fiat currencies should ask is how much of their wealth and income should be in a fiat currency. And my argument is less than 50%. I think we are going into a final moment of testing here, which could be the fiscal problems alone will cause us difficulties, but the external threats that we haven't really talked about are rising Russia.
You say that Russia is the main beneficiary of an increase in oil prices right now.
Absolutely. I mean, if you look on simple macro terms, if you look at Russia's fundamentals, it has a relatively small population and a gigantic country. It has minimal debt. It has positive cash flow. It has massive oil and gas reserves. And, you know, it really hasn't been of late expansionary around the world.
All right, so you mentioned fiat currencies, and I'm taking away from that you think gold is a good investment.
I think that gold, I would add physical gold cautiously, depending on how much you already have in your portfolio.
What about Russian energy companies?
Unfortunately, while I'm bullish on their macro pick, I like to invest in countries where there actually is a rule of law, and I don't see that yet. I see, on the other hand, many examples in recent history where even people, I believe the son of the American Communist Party had his head handed to him investing in Russia. Large oil companies have had their head handed to them. I'd be very timid about investing in Russian equities until we saw clear evidence that foreign investors would be protected in that country.
All right. I want to thank you very much, Charles Ortel, Newport Value Partners. I knew I was going to have to get a rock, but, you know, I'm going to hide under it. Maybe you'll join me a little bit later. All right. Thank you very much for your insights.